Thursday turned out to be extremely volatile for the oil market. Amid growing fears of supply crunches, the quotes headed for new record highs. Brent crude oil exceeded the level of $119 per barrel, a 9-year high. WTI crude hit $115, the level not seen since September 2008. Thus, oil prices have gained by about 14–18% this week. True, fever in the oil market eased by the end of Thursday. Its rally was limited by Iranian oil minister Javad Aouji's statement. He said that the country could increase oil production within 1–2 months after sanctions are lifted. If Iran agrees to resume oil supplies, this move will support the market. However, this is just a statement. Without real steps, fears of energy shortages may quickly grip the market again. On Thursday, Brent crude oil futures approached the level of $120 per barrel. Then the asset entered a technical correction, thus sliding to the area of $110 per barrel. Despite such a significant decline, there are no signs of a trend reversal. Trading excitement as well as speculative interest persist, and market sentiment remains bullish. Therefore, Brent crude is expected to recover from its correction and head towards new local highs in the near future. As for the foreign exchange market, the ruble is still trading downwards. On Thursday, the Russian currency broke through an all-time low, reaching 118.35 rubles per dollar. True, in the late trade, the ruble managed to win back most of its intraday losses on expectations of peace talks between Russia and Ukraine. The dollar-ruble pair closed at the level of 106 rubles per dollar, but kicked off the new trading day with resumed gains. In general, there are almost no positive factors that could support the ruble. The West has announced the start date for the disconnection of certain Russian banks from SWIFT. Europe threatens to disconnect all the banks of the country from the system. In addition, the ruble is being weighed down by targeted sanctions against corporations and certain economic sectors, as well as threats of abandoning Russian oil. Furthermore, international ratings agencies Fitch, Moody's and S&P decided to cut Russia's credit rating deeper into junk territory, or rather to the pre-default level, that is the level of Mongolia, Libya and Nicaragua. In this situation, diplomacy is the only hope for the Russian currency. So far, negotiations between Russia and Ukraine have not been fruitful. Yesterday, on the Moscow exchange, the dollar-ruble pair hit a record high of 118.35 rubles per dollar and then entered a correction. Judging by its dynamics, market participants do not react to the actions taken by the Bank of Russia to prop up the ruble. Therefore, the US dollar will most likely continue gaining value. Its upward cycle will probably consist of speculative momentum, followed by a pullback or a correction and new momentum again. In the meantime, gold continues its sluggish movement. The main factor constraining its bullish run is sanctions against the Bank of Russia that affected gold reserves. Although some analysts still see gold as a superior store of value, investors are in no hurry to invest in the metal. Panic in global markets and new sanctions do not allow market participants to assess the situation and redistribute assets wisely. Of course, the asset's growth potential is still high. However, it's not worth counting that global uncertainty will definitely drive gold prices up. Thus, there is a likelihood that the yellow metal will keep drifting within the recently formed channel. From a technical point of view, gold futures still managed to gain upside momentum on Thursday. The quote jumped to the area of $1,945–$1,950 per ounce and then pulled back. If the price consolidates above the level of $1,950 per ounce on the 4-hour chart, the asset will extend gains. Otherwise, the metal may start trading sideways. And this was the forecast for the end of the trading week. Please have a profitable trading day and keep watching our news releases. See you back soon.